Hi, and it's Kevin Wright here with another property finance tip. What's it about this week? Well, if you're just starting out in property and you're wondering how exactly you get into being a property investor, because it looks a bit more complex than what it may seem on the surface, then I've got some key little trigger points here for you this week that's going to help you to understand what direction you need to go in and what decisions you're going to need to make to keep you safe and so you don't make some mistakes and buy some properties that you end up wishing you really hadn't bought. So, hang around, keep watching. Now, I often get asked, how do we start off in property? Well, it's a great question. And my response is to be aware and to understand that investing in property, in one sense, is an exercise in risk mitigation. So what do I mean by that? Well, you need to understand what not to do in order to get it right. So there's a whole list of things that you need to focus on to make sure that your investment is a good investment. So let's look at those. We'll headline them to start with, and then we'll drill down into a bit more detail on each of them. So where do we go? Let's start. And this is about discipline in selecting the right property and avoiding buying the wrong property. So what things are important? What type of property to buy? Where geographically should you buy it? Who should you buy it from? What purchase price should you pay? What are you going to do with it? Who are you going to rent it to? And how are you going to finance it? So, whole load of things there. Okay, let's drill down. Let's go through these one by one. What to buy? So, you need to understand what type of property you want to buy. Now, investors tend to buy mass market properties that either sell well whenever you want to sell it, and that might be fairly soon if you're flipping it, longer if you're going to rent it out. But it's going to be a mass market property. So there are typically three types of property, more than any other. Flats, terraced houses, semi-detached houses. Those are the three mass market types that people choose to buy. Go beyond that, start going into detached, and your options start to narrow. Who's going to buy it eventually when you want to sell it, and who you're going to rent it to. Now, okay, bigger detached houses you can split up and do into an HMO maybe. But if you're saying, well, I could take a big house and convert that into flats, you could, but you're now back into flats, terraced and semi-detached houses. So keeping it mass market is keeping your options as wide open as possible for rental and for eventually selling. So where to buy it? Well, geographically, there's you can buy anywhere in the UK, can't you? Really? Now, one big limiting factor is going to be price. So the amount of cash that you've got available is going to restrict where in the UK you can buy it. And in the more affluent parts of the country, your cash available may exclude you from those areas. So where you buy is geographically, cash is going to be a big limiter, and I mean cash for deposits. And the use you're going to put it to is another factor. So no point doing an HMO in a little village miles from anywhere, because you're going to struggle to rent it out. So the location has got to be consistent with the use that you intend to put it to, and some due diligence around demand for the way that you want to use the property. So some due diligence around demand for how you intend to use the property is a key aspect. Now, who should you buy it from? Well, obviously a seller, but it's more detailed than that. The key phrase, and this is an endemic phrase throughout property investing, is a motivated seller. Now, if there's 1 million properties for sale on Rightmove, and there probably is somewhere around that amount on a week in, week out basis, and also Zoopla and on the market too, because Rightmove is not the only property search engine, is it? So if there's around, let's say 1 million, well, every one of those wants to sell their property, otherwise why bother to list it? But the point is, the majority of those people can afford to sit around and wait for asking price or close to asking price offers to come in. And they don't really care whether it's 6, 9 or 12 months. There's no real urgency there on their part to shift the property quickly. If it sells, it sells. If it doesn't, it doesn't. We'll just wait until we get the price we want. Now, typically, they're not the ideal seller for you as an investor. The ideal seller, and the ones that we really want, are the ones that got something more urgent going on in their life. And there are a whole host of reasons that I go into in other videos that make up a motivated seller. But it's some personal issue in their life that's driving them to take a course of action, and the block on that's stopping them progressing is this property that they have yet to sell. So the property is stopping them getting on with their life. If we buy the property and buy it well, if we buy the property, we're removing the block and it allows them to proceed with their life. And that tends to be something that they're keen to do in the shorter rather than the longer term. Not necessarily in the next couple of weeks, that would be really acutely motivated, but certainly in the next couple of months, and certainly not in the next 12 months. So the focus is to find people with a need to sell rather than the weaker, watered down, just want to sell. So if buying from a motivated seller is important, then buying at the right price is important too. Now, it's an old saying, I didn't invent it and I wouldn't claim to, but you make your money when you buy it. And this isn't restricted just to property. You know, on most things, if you're going to make a profit on it, in other words, if you're doing it from a business standpoint, then the price you buy at is the critical price. Overpay and your profit margin is squeezed at best. And in property, and if you're doing the ever popular buy, refurb, refinance philosophy, if you want to call it that, because it's more than a strategy, it's bigger than a strategy. If you're doing that, then the price you buy at is critical, because that determines, to a large extent, how much you're going to be able to pull out when you refinance. So how much you pay for it is very important. So no, one of my other videos, if you have a search around after you watch this, is a detailed video in how to work out never overpaying for a property. So check that one out. So paying the right price, really, really important. So once you've bought it, what are you going to do to it? Now, buy, refurb, refinance is all about adding value. So if you're going to add value to a property, how are you going to do that? Most of the time it will be a refurb, but how much of a refurb? Is it a quick cosmetic refurb, or is it a bit heavier in terms of knocking walls down or maybe putting an extension on or something like that? So what you're going to do to it is important too. And of course, cost that up as well, because you don't want to do what I've seen people do in the past, go way over budget on the improving the property to the point where it's actually worth less than you've spent on it cumulatively buying it and improving it. That certainly the mass market properties that we're talking about, every property has got a ceiling price. You know, no one's going to pay £250,000, for example, for a property in a street where the maximum price that a property's ever sold for is 150. If you got 250,000, you'll go and buy in a better street, won't you? In a better part of town, or maybe even a different town. So how much you spend on it, improving it, is equally important. But there's other ways you can do it. You can split titles, you can get planning permission granted to do something that increases the value of the property. You know, and some people make a living just out of doing that. They never actually do anything to properties. They just get planning approved to be able to do something, then sell it on to someone else. And make a profit on that. So what you plan to do with the property once you bought it is also important. And the next thing instead is, well, who are you going to rent it to? So what's the market like in that area where you're buying the property? If you're doing single lets, is there a market for that? If you're doing HMOs, okay, how many other HMO rooms are available at that time? Is there an oversaturation of rooms compared to tenants? Or is there a big demand from tenants and not enough HMO rooms to satisfy the demand? So where does that sit? It's important to get your marketing right so that you understand there's a demand for the way you want to rent the property. If it's a commercial one, for example, and it's a shop, it's a vacant shop, yeah, but can you fill it? Can you fill it with a commercial tenant? So who are you going to rent it to, and does the demand exist? That's a very important factor. And lastly, we looked at how to finance it. Well, that's going to be important too, because you want to finance it correctly and in intelligently. You don't want to be committing any sort of fraud or any sort of deception to the company, lender, person that you're borrowing from. But of course, you don't want to overpay either. So there's a fine line is to say, is it going to be a mortgage, or does it need to be a cash purchase? And is it my cash, or is it someone else's cash? Or is it going to be bridging finance, or is it going to be development finance? And whichever one of those it's going to be, can I get the best of the bunch in whichever category? Or is it going to be, is it privately, you're going to refinance it privately, and how would that work? So how do you find someone you can trust to lend you the money? Because the potential issue with borrowing money privately is you're dealing with people that are emotionally attached to the capital that they've got, usually because it's come from an irreplaceable source, like an inheritance, for instance. So that's another issue to work out, is financing it correctly and getting your best bang for your buck, to quote a phrase. There's a whole lot of stuff around there about how to get started in property. It's a discipline to select the right property by understanding what would be the wrong property in any of the aspects that we've covered, is the wrong property to buy that actually you're going to end up regretting. Because every property you add to your portfolio should be one that you look back on and say, that was a good buy. Over a period of years, your focus may change and you may want to do a bit of pruning. You may want to get rid of some of the earlier properties you bought that no longer match your desired strategies that you're running. And that's okay, that's a natural progression. But you want to avoid thinking, oh my God, why did I ever buy that property? If only I knew then what I know now. And how many times have you heard people say that in the past? So that's it for this week. If you're just starting out in property, hope you found that useful. It's a process that some of your predecessors that are further on in their property career have gone through. Some didn't do it so well to start with and then had to rectify some of the mistakes that they made. So if you found that useful, great, hang around, because I've got something else that might be interesting for you. Thanks for watching this video. If you've enjoyed it, hey, I've got an Instagram channel too. There's some really interesting content on there, and it's all short, snappy stuff. So it's at Kevin Wright Property. Check out the link here. Go find me on Instagram.